Today, the commodities ship may not come in this time. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and broad news with a distinctively Australian flavour. Well, there's something weird happening. Despite the strong rise in a pantheon of commodity prices, commodity exporters are not feeling the love in terms of currency appreciation. The currencies of commodity exporters, for example, the Canadian dollar, the Aussie dollar and the New Zealand dollar, have underperformed the rise in commodity prices themselves. So what's going on? Well, Goldman Sachs had a good go at trying to explain what's happening. They said for years it was a rock-solid relationship. When commodity prices climbed, the currencies of commodity exporters would get a lift too. But that bond has weakened recently. West Texas Intermediate crude has risen 30% to more than $100 per barrel since the start of the year, and copper has gained 10%, iron ore 26%, and thermal coal 33%. The commodity currencies in the G10, meanwhile, appear stuck within a narrow range. The Canadian dollar, which is their preferred long in G10 this year, sits close to where it stood in March 2021, when the WTI prices were sitting at around $60 per barrel. So what's behind the weaker link? There are two general ways the commodity currencies have historically benefited from higher commodity prices. The first is through a boost in the balance of payments, reflected in an improved trade balance in the current account, and foreign investment flows in the financial account. The second is through a net positive impact for local economies as commodity-based industries increase business investment amid rising commodity prices. In both cases, the latest surge in commodity prices has not yet translated into the type of investment spending that can contribute to foreign exchange appreciation. So let's look at firstly the balance of payments channel. They can attribute much of the relative weakness of these currencies to the nature of the foreign liabilities being accumulated. In contrast to the previous commodity price cycle, Australia, New Zealand and Canada have run what they consider to be relatively low quality current account balances, since a smaller proportion of the liabilities has been accumulated in the form of foreign direct investment, which tends to be of a longer term nature than equity or debt portfolio flows. So they think this difference has likely contributed to the lackluster foreign exchange performance. And in terms of the capital expenditure channel, in addition to lifting each economy's terms of trade, the previous commodity price cycle also raised profit margins in certain commodity-oriented sectors and encouraged businesses to invest to increase production. In the past, business investment in Australia and Canada closely followed the terms of trade, with a lag of roughly 1 or 2 years. However, much of this new supply accumulated during the 2000s and hit the market just as growth in China started to slow and US shale oil production started to pick up, weighing on commodity prices during 2014 and 2015. And just prior to the late 2014 crude price crash, energy sector capex accounted for roughly 1/3 of all business capital spending in Canada. That spending, however, never fully recovered, and capital spending now plays a smaller role in overall GDP than in the past, contributing to the weakening link between oil prices and exchange rates, as emphasised by the Bank of Canada Governor Mecklem in remarks just last week. That could reflect several forces, including environmental policies that are seen as increasing hurdles for mega project approvals, investor reluctance to buy back energy sector projects, and or expectations that high oil prices could prove temporary. However, as can be seen, the Australian dollar and the New Zealand dollar have also underperformed commodity prices, implying that these issues are not specific to Canada. In order to better understand the relative underimportance of commodity currencies, they turn to their behavioural Aquarium exchange rate model, which estimates short-term fair value in the crosses using common indicators such as changes in oil prices and changes in rate differentials. And as can be seen, cumulative residuals from these models resemble measures of real activity in the domestic commodity producing industries. In other words, these currencies tend to outperform typical short-term correlates when commodity investment is strong and underperform when commodity investment is weak. Thus, The restructuring of the commodities sector, with investment and labour flowing to other sectors of the economy after the global financial crisis in 2008 and 9, likely contributed to the underperformance of commodity currencies more recently. The currencies of commodity exporters such as Canadian dollars, Aussie dollars and New Zealand dollars in the G10 have underperformed the rise in commodity prices themselves. Part of the explanation likely relates to the geopolitical drivers of the recent surge in prices, which might be expected to reverse. So, if the RBA lifted rates, would that make a difference? Well, their latest minutes noted that over coming months, important additional evidence will be available on both inflation and labour costs. Actually, the labour cost information will be available on May the 18th through the wage price index and May the 19th on the employment report. So Westpac is now saying, following an expected substantial lift in underlying inflation in the March quarter and a fall in the unemployment rate from 4% to 3.8% in April, they expect that the RBA will decide to lift the cash rate by 40 basis points at its board meeting on June the 7th. With the exception of the larger increase in June, the rest of the profile remains in place, with the rate by November reaching 1.5% rather than 1.25%. And the expected pause in December also remains, with two 25 basis point hikes in February and May next year. Indeed, the markets are betting on a string of rises, which would help the Aussie dollar, but then again, strong lifts will crash home prices. So there are probably limits, although exactly how far those limits will be stretched by what happens when the Fed lifts hard, as they're going to. So, are there any other options to drive the Aussie dollar higher? Well, as Macro Business pointed out today, what if Australia enjoys another gigantic mining investment boom, as large as that which transpired post the global financial crisis? In fact, the chart here shows the price driver is there for a renewed investment boom, but it is not on the books yet and is not likely to happen for a number of reasons. First, the key price drivers of the boom are the bulk commodities of iron ore, thermal and coking coal. Of those, iron ore is in a structural glut and will attract no investment. Ditto for both coals, which are under ESG pressure permanently. Now, there are base metals and green metals, but these are quite small by comparison to the bulks. And that leaves gas, which could get a new project in Western Australia, but nothing like the East Coast boom post-GFC. So in short, the prospect of another once-in-a-century mining boom just 10 years after the last is very slim. So there is no economic tailwind that would require the room to drive interest rates so high. So MB suggests that we'll see a few hikes running into a major global bust over the next year or so, with a 5 to 10% house price correction before the RBA is begging everyone to buy houses again with cheap money. And a weaker Aussie dollar follows, of course. So we are, I think, in this new world, and we can't bank on the commodity sector saving us this time around, which is a problem because we don't have much else in the locker, particularly if in fact house prices ease and construction also comes off as well. After all, Australia is about houses and holes. And if both holes and houses go the wrong way at the right time, that's going to be a big problem. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.